It's gradually become clear to me why the mainstream news cycle used to be 24 hours, and now it continues moving towards more and more superficial and impulsive news. I mean, they're so heavily focused on the here and now that they completely miss any larger picture that could be shown, much less examined. But this isn't an accident, this isn't a coincidence. There's a reason that a dollar in the early 1900s has lost over 96% of its value compared to today's dollar. There's a reason that the rich continue to get richer. And it's not the fault of free market capitalism, but rather a largely veiled power grab that can only be participated in by a select few. There's a reason that while overall wealth is increasing, the wealth gap between several big banks, career politicians, and government-supported businesses, which do not adhere to free market principles, is increasing. When you look at big banks, fractional reserve banking is part of the equation, but it's not the entire story, because they also get continuous bailouts and subsidies. This physical money that they're given isn't supplied solely through taxation, but rather through collective devaluation. And why is this even possible? Because of the Federal Reserve Act of 1913, whose purpose was to stabilize the American economy by instituting a central bank. Now, some quick math will show you that the Declaration of Independence was issued in 1776, while the Federal Reserve was established in 1913. That means that for over 130 years, the U.S. operated perfectly fine without a Federal Reserve Bank. However, there were 3 prior attempts to centralize U.S. banking, all of which failed for one reason or another. The first attempt was the Bank of North America, whose charter was written up in 1781. It was modeled largely after the Bank of England, and when the Bank of England tried to place the American colonies under its rule, that was seen as the breaking point that led to the American Revolution. The Bank of North America was based on a plan presented by Robert Morris, the U.S. Superintendent of Finance. It started by dispersing 1,000 shares at $400 each, and Morris bought up 63.3% of the shares for the government using gold, silver, and various bills of exchange that were obtained through loans to the Netherlands and France. Then the Bank of North America, in turn, issued paper currency backed by this supply of foreign loans and specie, also known as hard money. By 1786, the Bank of North America was seen as a creditworthy institution, and starting just a few years earlier, citizens could pay state taxes with Bank of North America certificates. At the time, a lot of the drive for a central bank was the fact that wealth transfer was difficult without it. I mean, the colonists could transfer wealth with commodity money, which just means that the value of the money is tied up in the physical item, like gold, silver, grain, livestock. And the colonists also had paper money that was issued as a banknote mortgaged on the value of the land that an individual owned. Not to mention that the continental currency was failing, and the government was unable to pay soldiers serving during the Revolutionary War. The idea of a central bank was to consolidate the monetary system under one federal agency and make the country more attractive to foreign investors, as gold and silver reserves were dwindling in America due to international factors. Now, Pennsylvania rechartered the bank under stricter constraints that limited what it could really do, but it allowed it to operate and be protected in Pennsylvania as long as the Pennsylvania Commonwealth received favorable loan conditions. At this point, the Bank of North America had few dealings with the federal government aside from small loans during both the War of 1812 and the Civil War, and then in 1791, the first Bank of the United States was chartered. This was more heavily modeled after the Bank of England. Now, the first bank was responsible for 20% of the issued currency, while state banks were responsible for the rest. The great Thomas Jefferson, along with many others, saw the bank as a primary driver for corruption and monetary manipulation. And the first bank lasted until 1811, when its 20-year charter ended and it was not renewed by Congress. Treasury notes then had to be issued in the years that followed, for the sake of creating credit to fund the War of 1812. Soon after this, there was a suspension of specie payments by banks, and because of the credit manipulation effectuated by the issuance of treasury notes, there was seemingly runaway inflation, and in 1816, James Madison signed the charter that would establish the Second National Bank, with the intention of stopping the inflation. It was nearly an identical copy of the first national bank, which spread all across the country. When Andrew Jackson was elected president in 1828, he said something similar to what Jefferson had said about the first national bank, that it was a driver of corruption. And then in 1834, the U.S. adopted the gold standard, where a dollar was worth approximately 1/20th an ounce of gold. So now you see that Andrew Jackson being on the $20 Federal Reserve note is the definition of irony. He ended up dismantling the bank in 1836, even though there were several other private banks at the time with little to no gold to back their banknotes. Jackson wasn't able to dissolve the Second National Bank, so he just let the charter run out and he refused to renew it. Then the Panic of 1837 hit when Jackson ordered that all federal land payments must be made in gold or silver. This caused profits, prices, and wages to plummet while unemployment soared. But from 1837 to 1862, there only existed state-chartered banks. Now, these state-chartered banks had existed since 1781, existing in parallel with the Bank of North America and the First and Second National Banks. But these state-chartered banks would issue banknotes against gold and silver coins. The states would heavily regulate reserve requirements, interest rates, and capital requirements, which capital requirements is calculated out of the perceived financial risk that a bank takes. Now, the average lifespan of banks during this era from 1837 to 1862 was about 5 years. Half of the banks failed, and a third went out of business because they couldn't redeem their banknotes. So, while it's been called the free banking era, it wasn't true free banking because while there were no federal regulations, there were state regulations. And during this period, the New York Safety Fund was established to provide deposit insurance for banks that became a member, and the Safety Fund guaranteed that banknotes distributed by member banks would all trade at roughly the same value. And then the National Banking Act of 1863 and 1864 was established. The idea had three main parts: to create a system of national banks that had higher standards than state banks, to create a uniform national currency, and to finance war by holding treasury bonds, which are basically IOUs pumped out by the US government. Just 2 years prior to this, in 1861, Congress suspended the gold standard with the start of the Civil War and began printing greenbacks as a fiat currency. This was supposed to be phased out under the Specie Payment Resumption Act of 1875, but then in 1878 that was suspended and the greenbacks stayed in circulation. And then in 1879, the US returned to the gold standard and all currency could be exchanged for gold. However, it wasn't until 1907 that corruption really started to have a lasting effect on the banking industry, as centralized banking was proposed by big banker Jacob Schiff. He warned that without a central bank, America will undergo the most severe and far-reaching money panic in its history. For a 3-week period in October of 1907, he was right. Many state banks, local banks, and businesses declared bankruptcy. And there were massive bank runs as the stock market fell almost 50% from the peak the previous year. And to explain the primary cause of the panic, it's important to understand the term liquidity. It describes the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. It's essentially a measure of how stable the price of a product is. The primary cause of the panic of 1907 was a retraction of market liquidity spurred by several New York City banks. Banks worked to corner the copper market on the United States Copper Company, operated by the Copper Kings in Butte, Montana. Several banks had invested money in this cornering operation, and when it failed, there were bank runs that quickly spread to their affiliates like Ebola in a crowded room. As the New York Stock Exchange was staring at a closure to prevent brokers from failing, the president of the New York Stock Exchange went to J.P. Morgan, where he received about $27 million in 15 minutes to prevent closure. But J.P. Morgan doesn't exactly have a clean past. The bank started as Peabody Morgan & Co. by J.P. Morgan's father and George Peabody. George Peabody was closely tied to the Rothschilds at the time, and when J.P. Morgan established his bank, it was, and still is believed to be a shell bank for the Rothschild family. In fact, between 1895 and 1896, when J.P. Morgan was selling U.S. gold bonds to Europe, that was seen as an action taken on behalf of an alliance with the Rothschild family. At the time, J.P. Morgan controlled the flow of gold in and out of the U.S., and in 1904, John Moody, founder of Moody Investment Services, said that it was impossible to talk of Rothschild and Morgan as if they had separate interests. As I said before, Jacob Schiff is one of the big bankers who advocated a central bank, and he had tight Rothschild ties in Europe, as well as to Carnegie Steel, Harriman's Railroads, and Rockefeller's Oil. And quick fun fact, Edward Harriman, the railroad tycoon, had a son named Averell. Averell went on to become a Skull and Bones member who helped found Brown Brothers Harriman. That firm bankrolled Hitler's rise to power, while Jacob Schiff bankrolled the Soviets' rise to power. It's not a coincidence that these two men financed these two incredibly authoritarian regimes, and it's not like they each individually had separate feelings about this. They both saw the regimes as a way to push power to a few at the top. And it wasn't just them, but they were after an authoritarian government. Now, the reason that I'm going through all of these strange occurrences in these sketchy individuals is that the Panic of 1907 is seen as purposeful. It wasn't an accident. It was orchestrated by big bankers so that they could push for a centralized bank. And to make matters worse, the Federal Reserve was officially established in 1913 under Woodrow Wilson, who pulled out U.S. forces from the Soviet conflict in 1919 and 1920, which led to the Russian Reds winning the key territories of Vologda and the port of Archangel. And this is seen as possibly shifting the momentum of the Russian Civil War, which officially ended in 1922, even though the Soviets already had massive amounts of control over the government in the years prior. But now to take a step back to the creation of the Federal Reserve in 1913, it was a slow growth into what the Federal Reserve is today, although at its inception, it was a power magnet designed to create conditions that would require more power to be funneled to it. The stated purpose initially was to create an elastic money supply so that monetary panics could be prevented, although it was understood that it should be a last resort. Now, the Federal Reserve Act of 1913 contained the Federal Open Market Committee as well, which holds immense power over monetary policy because it can direct the purchase and sale of government securities on the open market. To inflate, they buy securities from a select few firms, and to deflate, they sell securities. They can act completely on their own discretion with this, but only a year after its creation in 1914, World War I broke out after the assassination of Archduke Ferdinand. This caused Austrian and Serbian forces to mobilize, and quickly Britain, France, and Russia were on the side of Serbia, and Germany, Austria, Hungary, and Italy were on the other side. And because of how it was set up, the Federal Reserve was in a better position to issue war bonds than the U.S. Treasury, meaning that they became the primary supplier of these bonds at the direction of the Treasury. Now the Federal Reserve could create and destroy money just like a central bank, and they could fund war without needing real money. Under Woodrow Wilson, the massive banker Paul Warburg, who was tied in with Schiff and Rothschild, and several others were appointed to run the Federal Reserve System. Now, because of the way that the Federal Reserve can print money and inflate the currency to stimulate an economic boom that holds within it the seeds of its own destruction, we see the Great Depression in 1929 come as a result of that, where the economy is propped up on rotting wooden stilts with a tsunami of reality approaching. Jump forward to 1933, when FDR became president, and the Federal Reserve was still under the authority of the executive branch of the federal government. In that same year, in 1933, FDR took America back off the gold standard. The difference was that FDR confiscated the people's gold. Under him, there was a massive push to spend us through prosperity. Even though we really needed lower taxes and lower spending, FDR decided to seek huge amounts of money to fund his programs. He said he was going to put an end to poverty, but then the Depression got worse. After a 4-day bank holiday where he absolved the fractional reserve banks of any need to repay depositors, he had to create a means for people to feel safe when they deposit money into banks. So he created the Federal Deposit Insurance Corporation. In reality, it held just 0.5% of all of its deposits, but there was the assumption that if there was a bank run, the Federal Reserve could print money for them. A lot of this makes sense when you realize that FDR appointed James Warburg, the son of Paul Warburg, to be his financial advisor. And one of the more famous but still lesser known quotes from James Warburg is, "We shall have world government, whether or not we like it. The question is only whether world government will be achieved by consent or by conquest." To give this quote some context, he said this regarding the tensions between the US and Russia, but it was prefaced by the quote, "The past 15 years of my life have been devoted almost exclusively to studying the problem of world peace and especially the relation of the United States to these problems. These studies led me 10 years ago to the conclusion that the great question of our time is not whether or not one world can be achieved, but whether or not one world can be achieved by peaceful means." When Warburg pointed out Russia and the US, he was more pointing out a geopolitical issue that could lead to a world government, but he was still under the assumption that a world government would happen and he'd prefer to be ahead of the curve. This means that he's going to view everything through the lens of an inevitable world government, meaning that he has motivation to try to push for a world government since he sees it as inevitable. Better to run into the fire and control the situation than sit back and let it slowly roast you alive. Of course, a world government is not inevitable, but Warburg's past is certainly conducive to his idea that it is. And the name Warburg will come up again later. Now, after the death of FDR in 1945, Harry Truman took over the presidency, and in 1951, the Federal Reserve gained independence from the Treasury, granting the Federal Reserve the ability to operate monetary matters while the Treasury had control over fiscal matters. And just to clarify, monetary policy is referring to interest rates and the total supply of money in the economy, while fiscal policy is referring more towards taxation and the spending habits of the federal government. Now, I'll discuss JFK at the end of this video, but LBJ had the idea to print more money to fund expensive social programs, some established largely by his predecessors, even though LBJ had his Great Society disaster. And he was also printing money to fund the Vietnam War, which got us involved based on lies and then portrayed our troops as baby killers and savages when they got home, which was also born out of lies. LBJ thought that he could fund economic growth at home and fund the war without raising taxes, even though the collective devaluation of everyone's currency through inflation is a form of taxation. It's just more tame, meaning that people are less likely to revolt over it. And slightly prior to this, there was the Bretton Woods Agreement that only foreign official institutions could redeem US dollars for gold. That meant that central banks and foreign governments could redeem US dollars for gold, but not citizens. Post-Vietnam War, when foreigners saw the runaway inflation, they started redeeming their US dollars for gold, and the US paid out billions in gold. And they were still left with $36 billion in gold debt to foreign countries, but they only had $18 billion in the gold reserve. In 1971, rather than try to fix the monetary system, Richard Nixon suspended the ability of foreign governments to trade dollars for gold. This wrecked the Bretton Woods Agreement, but it was good for the Federal Reserve because now it meant that there was no gold standard backing the dollar. Nowadays, the Federal Reserve Bank of New York is by far the most powerful branch of the Federal Reserve, and the Federal Reserve Board holds meetings in secret. Why hold these meetings in secret? Well, if the American people got the truth from the Federal Reserve Board members, there would be a revolt. So the meetings have to be veiled in lies and secrecy. And then 1993 was the first time that there was a legitimate push to get the Federal Reserve to be transparent, and it came from the head of the House Banking Committee. He said that there should be an independent audit of the Fed, there should be taped meetings of the Federal Open Market Committee meetings, and the president should be able to appoint the Federal Reserve members instead of the big banks. Of course, Alan Greenspan, the chairman of the Federal Reserve at the time, opposed these measures. And Bill Clinton said that if these measures were put into action, it would undermine the people's confidence in the Fed. So the truth will be destructive, meaning people need to be blind to what's going on. And then in 1995, Mexico's currency plummeted, and Greenspan wanted a $52 billion bailout because the US held $26 billion in debt to Mexico. Taxpayers ended up having their collective currency devalued without any say in the matter. And the question could be raised, well, who owns the Federal Reserve? And as you'd expect, the answer isn't exactly simple. According to J.W. McAllister, an oil insider with connections to the House of Saud, 80% of the ownership of the New York Federal Reserve Bank can be traced to 8 families, 4 of which reside in the U.S. That would be Goldman Sachs, the Rockefellers, the Lehmans, Kuhn-Loebs of New York, the Rothschilds of Paris and London, the Warburgs of Hamburg, Warburg should sound familiar, the Lazards of Paris, and the Israel Moses Seifs of Rome. Thomas Schaff reaffirmed this claim, also stating that 10 banks control all 12 branches of the Federal Reserve. They are N.M. Rothschild of London, Rothschild Bank of Berlin, Warburg Bank of Hamburg, Warburg Bank of Amsterdam, Lehman Brothers of New York, Lazard Brothers of Paris, Kuhn-Loeb Bank of New York, Israel Moses Seif Bank of Italy, Goldman Sachs of New York, and J.P. Morgan Chase Bank of New York. William Rockefeller, Paul Warburg, Jacob Schiff, and James Stillman were also identified as being people who own large parts of the Federal Reserve. Not to mention that Stillman is a new name in this video, but Stillman married into the Rockefeller family prior to all of this. So while the Federal Reserve is supposed to control the U.S. monetary policy, it seems to be controlled by big banks and powerful individuals, all at the expense of the citizenry. The Federal Reserve prints money as the Treasury sends them debt bonds, which are supposed to be repaid at a later date. This allows the Treasury to order the Federal Reserve to create money without increasing wealth. This means that every dollar gets collectively devalued every time that the Fed prints more money. And sure, a portion of the money doesn't just go into circulation, but it still gets printed and put in a reserve at the big banks. This allows the banks to give out more loans through the fractional reserve banking system than they'd otherwise be allowed to give. And fractional reserve banking is something I'll cover in another video soon, but the banks are actually paid to keep their money at the Federal Reserve and out of circulation so that the currency doesn't get inflated too suddenly. Now with central banking, governments can fund war much more easily, and it's not a coincidence that the era of global war coincides with the era of central banking. When you subsidize something, you get more of it. When you give a government an endless pit of money to pull from, they won't hesitate to spend it, and they won't hesitate to use propaganda and the intelligentsia to convince the population that it's necessary. Or they'll just cover it up and devalue the currency massive amounts over such a long period of time that most people never notice it. That's why $1 in 1913 is worth 4 cents today. When the government wants to spend money, they just devalue the currency. The Fed also controls interest rates on the currency. So if they want the economy to look good, they push the interest rate down so the cost of renting money, because that's essentially what the interest rate is, looks low, and people will pursue riskier business ventures and they'll spend more and save less. This creates a bubble because people are spending more money than they should be because the economy looks like it's doing better than it really is. But if they want the economy to look worse, and this is what President Trump has accused the Fed of, they'll raise interest rates to make it seem like the market stability is disappearing and people should save more and spend less. In reality, the interest rate is supposed to allow people to communicate between markets and currencies. When that's being manipulated manually by an outside force, the Federal Reserve, the entire system will become imbalanced and we'll see monetary issues like we see under the Fed. Another issue is that the government can engage in arbitrage. They can receive large amounts of money freshly printed from the Fed and spend it before the currency value is corrected for inflation, meaning that they can buy more with a currency that should be devalued before it's devalued. Now, as a final point in this video, I mentioned LBJ earlier, and LBJ took over after JFK's assassination. There was a lot of belief that JFK was assassinated for trying to remove the power of the Federal Reserve. And while there are speeches about secret societies that run the US, the main talking point of people who think that he was assassinated by the Federal Reserve is that he signed Executive Order 11110. This gave the US Treasury the ability to authorize silver certificates and to coin silver dollars. This would have taken some of the power of creating money from the Federal Reserve. The Federal Reserve is able to charge interest to the government when they loan them money, and this would stifle their monopoly. Now, it is a fact that monetary interests have led to the assassination of world leaders before, and while JFK had several ideological differences with people, as any president would, that could have led to his assassination, people often point to the dates. Executive Order 11110 was signed on June 4th, 1963. He was assassinated on November 22nd, over 5 months later. And of course, it would have to be well thought out and planned instead of acting in just a matter of days, but the Kennedy assassination is just a rabbit hole on its own, and I figured I'd lay some of the groundwork for this theory behind his assassination being connected to the Federal Reserve. So, all in all, what can you do to stop this? Well, I don't think that there is much, but you can protect yourself from a collapse of the worthless fiat money that we all hold, and you can buy gold. If you have the money to save, I would buy gold. And also, I understand that voting is it's an inherently flawed system because you're having a group of people decide something that will ultimately affect everyone even if they don't vote for it. But when you go to vote, make sure that you have a keen ear for people who speak out against the Federal Reserve. Ron Paul is one who comes to mind as being particularly anti-Fed. And I'd also like to add that I tried to make this video as accurate and thorough as possible, but finding reliable information on the deep secrets of the Fed isn't easy because all of the sources are either saying, we need the Federal Reserve to have a stable monetary system, which is patently false, or they're just wildly attributing anything and everything bad to the Federal Reserve without any solid evidence. I mean, one that stands out in my mind is that Alexander Hamilton was anti-central bank and he was assassinated by Aaron Burr because of it. But that's not true. While Hamilton was opposed to a Federal Reserve type institution, and he was instead in favor of a national bank, which is not a central bank, it's not true that he was assassinated. He dueled Aaron Burr and lost, even though there's plenty of unfounded conspiracies around that as well. So, all in all, the information is all over the place, but I tried to bring everything together as succinctly as possible without missing anything huge. So, thank you all so much for watching. If you enjoyed this video, be sure to leave a like and subscribe. I also have donation links below. Thank you all so much for tuning in, and I'll see you in the next one.